Hey everyone, it's Ryan with Stock Investing and Trading 101. Today we're having a pretty nasty day in the markets. We had the CPI data come in hotter than expected, causing the major indices to fall, with the NASDAQ leading the way down over 3%. It's kind of bounced back a little bit, so it looks like we're at 2.9%, but pretty ugly day for the markets. Right at the open, over 90% of stocks, 9 out of 10 stocks in the S&P 500 were negative for the day. So a pretty painful day for most investors. The topic that I want to talk today is hedging. So I want to show you guys how I used hedges to profit on a negative day in the markets. Because a lot of my viewers, they're long-term investors, which I also consider myself a long-term investor. But there's tools you can use to add to your long-term investing that can protect you during down markets and actually allow you to profit if you are nimble enough to get in and get out of these instruments. To do that, I want to go over to my Thinkorswim account. So as I mentioned to you guys, told you guys my positions. I kept mentioning how I was hedged with VIX options on my Thinkorswim portfolio. This is my Thinkorswim portfolio. You'll see the VIX right here. So I had, I think, something like 5 options on the VIX this morning, which actually allowed me to profit $346 today from my hedges. I sold out of most of those hedges, and I actually used the money to invest into Apple, Amazon, Microsoft, QQQ, VTI, and VOO. So relatively safe investments, and I think they're at an attractive price. But the point here is that I was able to profit $350, and my long-term Interactive Brokers account only dropped $180. So pretty much I was able to profit nearly $200 off my hedge, and I didn't lose money on a down day. With that being said, I just want to quickly scroll through my positions, as I did add quite a few positions to my portfolio today. I bought some more Store Capital. This is a REIT with an annual dividend yield of 5.8%. That's the main reason I bought this stock, although it is a relatively safe investment, and considering that it's pretty much at the year low, the lowest it's been during the past year, I think there's relatively low risk. You have a stable 5.8% yield. I don't think it has significantly more downside to go, and I think it could go up at least 10 or 20% during the next year or so. Next, we have Intel, which I added to. I'm kind of down on this position. I was adding around 42 or 43. It's right now at 40, but this also has a 3.7% dividend yield. However, I think this stock has a lot more risk because they're pretty much in the process of rebuilding the entire company and building different foundries and stuff like that, and it's going to cost a lot of money, and they may not be extremely profitable during those years because of that. After that, we have Altria, very high dividend yield at nearly 6%, below $50 per share. I think it's a great value here. Realty Income, around $66 per share, nearly a 5% yield paid monthly, and very stable stock. You'll notice there's a theme here that it's a lot of dividend-paying stocks and a lot of kind of stable stocks. I'm looking for stocks that are very stable but still yielding like over 4%. Kraft Heinz could fit that list. We have Walmart, which is significantly beaten down. Disney, which is even more beaten down. Walgreens Boot Alliance, high dividend yield. Target, beaten down retail sector. Meta, I think, is at, if you're interested in being a Meta shareholder, if you're interested in investing in Facebook or Meta, I think now is one of the better opportunities you'll have. It's pretty much at its 1-year low. It's multi-year low, actually, and it's at an extremely low PE ratio of only $14 or 14 PE. So you're pretty much getting a growth company and one of the biggest tech companies in the world at a PE of 14, which I think is a pretty good value. We have Coca-Cola, which I bought today. Unilever, I added to today. TQQQ, this was just kind of a trade that I made, and I kind of made it at a bad time. Probably going to see what happens with this, but I would not invest in something like this if I was you. Next, we have ConAgra Brands, Union Pacific, Best Buy, Home Depot, Microsoft, which is at $255. I think this is also a great value and price to add to a position, especially if you have a long-term time frame. This is one of the best run companies in the world, one of the biggest companies in the world, and it's at a relatively attractive valuation. I wouldn't spend all of your Microsoft money right now, but you could average into a position if that's what you'd like to do. Next, Lowe's, Philip Morris, Amazon, AbbVie, Bank of America, Pepsi, Norfolk Southern, which is a transport company, which is also pretty cheap, along with Union Pacific. I think Union Pacific is a little more high quality, but these are both fantastic companies with a solid 2.2% dividend yield and a PE below 20. We have Kimberly-Clark, Procter & Gamble, JP Morgan, Shopify, Google, and United Healthcare. Google is also a stock that at a PE of 20, with all of the growth that it has in it, the size of the company, I think Google is just something that everybody should own, and most people do own in one way or another, and I would be adding to my Google position here. That's pretty much my portfolio at the moment, guys. The main point of this video, I wanted to show you guys how you can use hedges to profit on red days and keep your portfolio from experiencing too much volatility. And then I just wanted to show you guys my positions on my Interactive Brokers account, because usually I show you guys my Robinhood, but I actually have multiple portfolios, and I want to show you guys a little bit of each one of those. So, as always, thanks for watching. Don't forget to smash that like button, subscribe to the channel if you haven't already. Drop a comment, let me know how you're navigating these markets, if you were expecting this downward move, and what you are planning for moving forward. And we'll talk to you guys soon. Thanks.